Hey, welcome. If you've ever felt like the stock market is some kind of complicated, exclusive club, this is for you. We're going to break down the absolute basics step by step in just about 5 minutes. So, where does this whole thing even start?
Well, it all starts with a pretty simple question. You see a small startup, right? And then a few years later, boom, it's a household name. How in the world does that happen? What's the secret sauce that fuels that kind of massive growth?
At its core, the answer is money. Capital. To build new factories, to hire more people, to expand into new cities, companies need cash. And they usually need way more than a simple bank loan can offer. So, where do they get it? Well, in the early days, they might get funding from other firms. A perfect real-world example is how InfoEdge gave Zomato its early backing. But for that next giant leap, they turned to you, to the public, by selling off tiny, tiny pieces of the company itself. And that tiny piece of ownership, that's what we call a stock, or a share. So when you buy a stock, you are literally buying a small fraction of that company. You become a part owner. That's the big fundamental idea behind this entire world. Okay, so if you've got all these people wanting to buy and sell these little pieces of companies, you need a safe, organized place for all that to happen. You need a central marketplace. And in India, we have two main marketplaces, or stock exchanges. You've probably heard of them, the NSE, which is the National Stock Exchange, and the BSE, the Bombay Stock Exchange. This is the arena where all the trading goes down. Now with thousands of companies trading every single day, how on earth do you know if the market as a whole is having a good day or a bad one? I mean, you can't possibly track every single stock, right? We need a shortcut. And that shortcut is an index, like the famous Nifty 50. The best way to think of it is like a report card for the 50 biggest and most important companies in India. If the Nifty 50 is up, it generally means the market is healthy. If it's down, well, the market's probably feeling a little under the weather. But here's a really crucial detail. Just like in a group project at school, not everyone's contribution carries the same weight. Some industries have a much, much bigger impact on that final score than others. And when you actually look at the breakdown, it's pretty eye-opening. Just check this out. Financial services alone make up over a third of the Nifty 50's entire value. That is a massive slice of the pie. So, what's the takeaway here? It's simple. When that one giant slice, the financial sector, has a good day, it has enough muscle to pull the entire market's average up with it. It's kind of like the big engine that pulls the whole train. Okay, so we've got thousands of companies in the market. How do we keep them all organized? It would be total chaos otherwise. There has to be a system. Our source material has a fantastic way to think about this. Picture the stock market as a giant wardrobe. You wouldn't just throw all your clothes in there randomly, right? Of course not. You'd put shirts on one shelf, pants on another. The market does the exact same thing, using what we call sectors. For example, companies that make cars like Tata Motors and Maruti, they all get grouped together in the auto sector. Banks like SBI and HDFC are in the banking sector, and so on. This simple filing system just makes the entire market way easier to understand. All right, so we get what stocks are and how they're organized. But what actually makes their prices go up and down every single second of the day? It really all boils down to two main forces. You can almost think of it like a tug of war between logic and emotion. On the logical side, you have the classic economic rule of demand and supply. And on the emotional side, you've got what we call market sentiment, which is really just the collective mood or the feeling of all the investors out there. So let's start with logic, because it's pretty straightforward. When lots of people think a stock is a good deal, they all want to buy it. That high demand pushes the price up. Makes sense. But eventually, that price can get so high that it starts to look too expensive. New buyers stay away, demand falls, and the price starts to drift back down. It's a natural cycle. But here's the catch. Logic doesn't always run the show. Emotion, that market sentiment, can completely take over. Think about it. A huge global event, like a pandemic or a war, can cause widespread fear. And when people are scared, they might sell off their stocks no matter how well the company is actually doing. You know, fear and greed are incredibly powerful forces in this game. And that brings us to our final and maybe the most important point of all. You can do all the research, you can understand all the logic, but there is one more massive piece to this puzzle. Because picking a great, solid company is fantastic. But that alone doesn't guarantee you'll make money. It is only half the story.
This quote from our source says it all perfectly. You could buy a fantastic stock like SBI, a total pillar of the banking sector. But if you buy it when its price is at an all-time high, right before it's about to fall, well, that great company can turn into a bad investment for years. Your timing was just off.
And so that leaves us with the ultimate question for any investor, doesn't it? Finding a great company is the what, but figuring out the when, understanding the market cycles, the sentiment, and the price action, well, that's the real art. And that is the beginning of a much, much deeper